Hi, thanks so much for tuning in. You're watching BQ Prime, and I'm in conversation with Ajit Dayal, the founder of Quantum Advisors. Thank you so much, Ajit, for taking the time.
Thanks for having me, Alex. Appreciate
You
it.
know, before we jump into your perspective on markets and everything else, I was reading an article that you wrote a few months back, and you were talking about risk, the perception of risk, the calculation of risk, how it's used interchangeably with volatility, wrongly so. I think a lot of my viewers will benefit from that insight. Uh, how should the long-term equity investor view risk, and why is it so different from measuring volatility?
Great. I'm happy we're talking about that because I think, I wrote a comic book in 1987 trying to explain how a stock exchange works, functions, and what a stock market's about and how investors should actually use, make investments in stocks for long-term wealth. And in that, I had like a grid, like a pyramid sort of a structure. And basically saying at the lower level, at the base of the pyramid, you have what we call safe money, emergency money, sort of money. And basically it's low risk. The base of the pyramid is low risk. And as you go up the pyramid, you're taking higher risk. And as you go up the pyramid, you should be getting a higher return stocks. So one of the things about theory of in that investments and finances, there's a direct correlation, a straight line between risk and return. The more risk you take, the more return you should get. Kind of an upward sloping graph. And this was again, like I said, in the 1980s, in 1987, and ever since we've become internationalized, one starts reading about volatility and vol and all that stuff. I studied statistics, did MBA, studied investments, did economics. Volatility is the up and down movement of something. It just measures whether something went up and down and the sort of amplitude of it, if you wish, if I want to, use another word. Risk doesn't change because of an up and down movement of something. Risk is risk. And if you look at companies, you look at management, look at anything, you have to look at risk in a very, very different, manner. There's a certain risk of investing in companies which may be doing bad things, but making a lot of money today from doing those bad things, right? And their share price may not move too much. It may not be too volatile. So you'll say, that's a low risk company. Actually, no, it's a very high risk company because what if tomorrow governments change, governments' policies change, etc., and suddenly that activity that the company is doing is banned or is stopped? Then the share price will just go from wherever it is and fall like a cliff, like falling off a cliff. It'll have low vol all along the time, and you'll be lulled into believing that there was no risk. So risk is something very different, and volatility is something very different.
So that distinction is important to make. We're talking at a time, I think, when you have seen over the past couple of years, and I know you don't look at moves on a daily basis for the equity markets, which is why I've zoomed out and talked about the last couple of years. We've seen elevated volatility in global equity markets, in our markets as well. From that perspective, and you're looking at the Indian markets from the global lens as well, where do we stand right now, and how does the Indian investor understand the Indian equity market?
So, firstly, an Indian investor must recognize that stock prices in India will go up due to a few factors. One of the factors is flows. What are the foreigners doing with their money, with their savings? Are they buying or selling India? And we've been reading the headlines, FIIs, FPIs sold out of India. They bought a bit the last few months. And of course, what the local domestic investors do, whether through SIPs or through the insurance plans or whatever, but money moving into stock markets. That's flows. The other thing that will determine share prices in the long run is the fundamentals of the economic activity of the company, which really is a function of what's happening in the world and what's happening in India and what's happening in the sector of that company. Right? No one is going to be buying, mobile phones that are not smart. Yes. So if you have a mobile phone that's the old Nokia push button, you're dead. It's a dead business. You buy a smartphone today, you can have different models, competition, and also you have to check what's happening worldwide. Are they coming up with watch phones, with iPhones, with spec glasses phones? Who knows what people are doing, right? So all of that is evaluation of the business and the sustainability of the business to make money. And then Either that genius is recognized by flows or it's not recognized by flows. You can have companies that are very profitable, but no one's willing to take any risk and buy stocks. And so you won't see the share price go up. You can have companies that are doing very badly, the business is not so good, but a lot of money floods in and the flows will drive the share price up. So share price movements and expected returns in some sense are a function of the flows and a function of what the company actually does on a long-term basis. They will tend to equalize for sure. There may be spurts of times for a 1 year, for 2 years, where there's abnormality in either one or the other. A share can be underpriced or there can be excessive flows that are overpricing stocks. And I think the key to that, the reason I bring that up is that flows internationally are driven by the one global risk-free rate of return, which today is a US 10-year bond.
Yeah.
What any investor can earn in US dollars by buying a 10-year bond issued by the US Treasury, that is the riskless asset in the world. And if that interest rate has gone in terms of base terms from 0.5% a year ago, now inching towards 4%, it had crossed 4%, now a bit below 4%. If that's going to be elevated at 4-5%, everything else you do, keeping in mind the base of the pyramid illustration I gave you, if the US dollar is giving you a 4% rate of return, anything in equities should give you a high rate of return. Then anything in equities in India, which is even riskier from a US perspective than buying equities in the US. You're going outside your borders to a foreign country. You're taking that risk. Then you want a high rate of return. So as interest rates in America and the world are increasing, as a riskless asset is giving you better returns, you better be getting demanding a lot more return for the risk you're taking for being in Indian equity. And within Indian equity, again, base of a new pyramid, you have what we have done before, you got the value investing, right? Which is safer way to buy equities than right at the top of the pyramid. The tip of the pyramid is, for example, venture capital. Yes. Right? You're buying equity, companies are not listed, you don't know whether they'll make it or not. In between that is private equity. In between the value is, above that you got growth. Then you have mid cap, then you got small cap. So there's all of that risk element. So in terms of what will determine the future, to me, the riskless rate of return for the US bond is likely to be 4 to 5% for a sustainable period of time. And therefore, people will demand a rate of return in dollar terms of maybe 8 to 12% in Indian equity. 8% if you're a value investor, buying blue chips, as we call it, which have got good valuation metrics, or 12-15% if you're mid cap, small cap, 18-20% if you're doing venture capital. So that's kind of the spectrum of rate of return, which is very different from a year ago. A year ago, when the riskless asset was 0.5%, even if you made 5% in India in US dollar terms, it was great. It was much better than the riskless asset of the US. So this return will change over time as that US bond interest rates change.
So from that perspective, would it be correct to then assume that while we've been seeing some inflows from foreign institutions, they're going to be a little cherry of investing in a big way in the Indian equity markets because they get a sizable amount of money in riskless return?
Yes and no. Yes, on the basis is that right, but don't forget I said the other part is what's happening in the economic activity at the company. When I look around the world, India is, as we've been reading, the best positioned economy in the world to have great economic growth for the next few decades.
Yes.
Okay. From 1980 till now, for the last 40 years, India's GDP in real rate of growth, taking out inflation, has grown by roughly 6.2% per annum. We see no reason why we can't replicate that for the next 20 years across governments. There have been so many government changes from 1980 till now. There have been 10 governments in the last 42 years. There have been 10 governments, prime ministers, finance ministers, RBI governors, and we've grown 6.2% per annum. We can easily grow 6% per annum for the next 2 decades. That economic growth is basically a tailwind. It's going to ensure that companies will have, consumers to sell to, either domestically. Internationally may be a little more difficult for export because of where the global economy is slowing, but the domestic economy is doing very well. Infrastructure in India will do very well, etc. So there'll be companies that will make good profits. Our estimate is that actually Indian companies are likely to have profit growth of about 15% per annum in the foreseeable future. There'll be quarters when it's negative and all that stuff, but looking at very long-term numbers. Going back to your question, does that mean that foreigners will withdraw? Well, if I'm earning 4% in dollar terms on a riskless asset, and in the Indian context, I'm earning 15% in rupees, because profit growth in companies will translate to share price growth in companies in the long run. So if you take away 3% for the currency, that's a 12% rate of return in dollar terms by being in Indian equity,
sizable,
which is extremely attractive. That's why I'm extremely optimistic on India. So far, we get maybe 50, 60 billion US dollars in total across all asset classes every year. That can go up to $200 billion a year.
Wow. Okay,
I'm a big India bull in that sense.
Absolutely. And the other point, which is, and you spoke about flows, right? A lot has been said in the recent past about domestic flows as well. We're seeing SIPs to the tune of 13,000 crore rupees in a month. You're seeing significant inflows from the EPFO as well, supporting the Indian equity markets. How do you compare this to perhaps even a decade ago? And where do we see this going right now from this point on? Which leads me to another question in terms of the offerings of the mutual fund industry. Have they essentially covered all the bases as they stand right now? Or do you think that there's more to be done in the bouquet that is being offered?
So 2013-14, before Prime Minister Modi won the first election in 2014, April, May, there was about 3% of household savings in India found their way to stock markets. That number today is probably about 7-8%. Now keep in mind that household savings in absolute terms are growing. Look at this is the percentage. So and the percentage is doubled. So there's more flows today in equity mutual funds and stock markets, either individual stocks or equity funds through SIPs, national pension system, insurance plans, etc. And that's a big win. But we're still a lot lower than the world. In the US and the developed world, keeping Germany out, because Germans are a bit more risk averse and don't really buy that much stocks, you've got about 30% as a number that you want to achieve or want to get towards to kind of be comparable to what's happening in the US or the UK or Australia, New Zealand, etc. So at 7%, we still got a long way to go. So we think there'll be a lot more flows moving into India for decades into the future. The question that you asked about the mutual fund industry, or rather, what should an investor do? So you may have built the most, sexiest engine to transact and buy mutual funds or buy stocks. You may have a fund house with great branding all across the country and saying, I've got these, 200 funds to buy or 50 mutual funds to buy. How does the investor actually make money without taking on too much risk and without living with too much volatility? So I told you in a very optimistic way that Indian equity should give a 15% rate of return compounded for the next 2 decades, compared to 19% for the previous 40 years, for the previous 4 decades. That's a good number, 15% for the next 20 years. That does not mean that every investor will make that much money. They may end up buying the wrong mutual fund. And it does not mean either that they should put all their money into equity mutual funds, because they may put their money in and they may want their money out when a COVID hits and equity markets are down 30% from their peak and they'll be losing money, right? So you have to have a simple but well-diversified portfolio. Our grandparents told us, our parents told us, beta, beti, don't put all your eggs in one basket. That's basically the simple common truth, if you will. And that's why at the quantum mutual fund level specifically, we came out with what we called as 12-20-80, 12-20-80. Very simple way. And this is what I've been doing with my investments, my capital, since the 2005-6 environment, when I started having capital to start investing in mutual funds, etc. And we started quantum in 2006.
I read about that. It's 12 months of your expenses, 20% of your assets in gold and 80% in equity. And I was interested in this. I was going to ask you about this, Ajit, because 20% is a sizable amount to hold, and it is in fact more than a lot of personal finance advisors would say. They say on an average 10% of your assets can be in gold. You can have fixed income as well. Why do you say 20%?
So let me go back on the math of that, right? Because it's 12 months expense. So let's say I've got 1 crore to invest and my monthly expenditures are a lakh a month. Okay. And I want to keep 12 months money aside. So that's 12 lakhs of rupees gone. So out of 1 crore, there's now 88 lakhs left. And 88 lakhs is to go 20% into gold and 80% into equity. And
Right.
within equity, Quantum has built a solution where we even give you a pass-through through a Quantum equity fund of funds to invest in other fund houses.
Okay.
So there are 400 equity funds out there. We're telling you, we know value, we know ESG, give us a portion of that 80, but a chunk of that 80 is going to equity fund of funds where we pick the best fund houses from the 400 out there or 300 equity funds out there. They've got 10 funds, 10 offerings in that, mid cap, small cap, flexi cap, growth, whatever it is, things that we don't know and things that we don't understand or do. We've chosen those for you. But to go back to the 20% of gold. So 20% of the 88 lakhs that's left, if you will, in the math that you've just done, is about 18 lakhs,
Right.
roughly. So 18 lakhs on a 1 crore basis in this example works out to 18% as opposed to the 10 that you say. So the reason we've got that number is that gold is the only asset that's available in India, which you can buy in rupees, but is priced in dollars.
Right.
So the price of gold is not influenced by what happens in India. It's influenced by what's happening in the world market in dollars. Now, the dollar and the rupee, if you look at the equation from 1980 till now, over the last 40 years plus, the Indian rupee has lost nearly 3% per annum on average against the US dollar. So if the price of gold was to remain steady and not change, you can assume that the price in Indian rupees will go up by 3% every year because the exchange rate will have changed.
Right.
And the price of gold goes up by 4% or 5% every year in dollar terms, you get 8% return in India, right? In rupee terms. That's why we tell you put it in gold, because most Indians, many Indians will either have a desire to send their children to study abroad, which means they'll have a dollar cost or a pound cost in the future. Well, they have a dollar asset in their hand, which is gold.
So it's a hedge. It's a hedge essentially.
Yeah. It's a hedge. Now, of course, there are international funds you can buy. You can buy stock, but keep in mind that it becomes again volatility and risk. The volatility of a share, you may want your children to study in a particular year. If global markets are down that year, you're in trouble. It can also happen to gold, but gold is not going to plummet the way it can happen for stocks, not that sharply. So that's why we've got a little outsized, allocation relatively speaking to what you are, because it's the aspirational, and of course, on the engine that we built on 12, 20, 80, 12, 20, 80, you can change it to whatever you want. You think 12 is too much, make it 6. You think 12 is too little, make it 24. My personal thing,
based on your risk,
you what you want.
Correct. Risk-taking ability and all of that.
And sorry, and just to close, there's one thing that to recognize. I said it's not a one size glove, one fits at all. One size glove fitting everyone. You can tailor make it to what you want. That's the beauty of this engine.
Yeah.
So
fair enough.
I think mutual funds are offering products.
Yes.
What you really need to do is offer a simple solution, and Quantum is leading the way on that.
Okay. I do want to ask and delve a little deeper. You pointed out 6% is something that India can achieve over the next couple of decades. But what drives that growth, Ajit, from your perspective? And I'm asking from the perspective of trying to identify sectors, companies, businesses that could potentially be leaders over the next decade, over the next couple of decades, based on what is happening globally. India is trying to kind of capitalize on the changes that are taking place. Manufacturing is likely to be a focus area. Is that where you think that the opportunities lie?
Yes. So if you look at any economy, generally speaking, there are 3 things that drive economic activity. One is you either create goods in your country for domestic consumption, or you create goods in your country for export, or you have infrastructure spending going on in your country. You need roads, you need housing, you need school, you need bridges, you need ports, etc., etc. Those are the 3 very broad things that drive economic activity. So in India, the demand for everything is in some sense a lot. There's, on the domestic consumption side, we're very low on the domestic consumption cycle compared to many other economies. where we are in our economic cycle compared to them, compared to the Chinese. If you look at the per capita consumption of air conditioners and toasters and cars and two-wheelers, we're like way behind China and way behind the developed world in many products. So there's that consumption story. And all of that requires steel, which means you better have infrastructure building out, because you have to build ports, build power plants, you have to build transportation hubs to import that steel, manufacturers of steel, developers of steel, and the cement, etc. So
Yes.
you've got those things that will drive economic activity. So I don't think there's any one sector that I would say is the best. I think you can make investments across all sectors per se, but there is one sector which covers everything, which is the field of finance.
Yes.
Because everything requires loan, requires capital. And as we get wealthier, we begin to invest more. So you have the savings plan coming on, the insurance and mutual funds, buying stocks or brokerages, wealth management. So there's a whole spectrum in the field of finance that also I think will lift everything up and, be the driving force, if you will. The other point I think that's important is that in the economic thesis of 6%, why do we come to that number? So savings rate in India, for argument's sake, says about 28%. So households save 28% of GDP. And in economics, something called ICOR, incremental capital output ratio. Sounds complicated. What it really means is, how much money do I have to invest to get 1 rupee of output? So if I'm putting up a steel plant, it's very expensive to put up a steel plant or a cement plant because they last for 25, 30 years. Yes. So I put in 6 rupees to get 1 rupee of output. Or I put in 5 rupees to get 1 rupee of output. Now, if I put up a hair salon, right, or a little restaurant to serve you fast food, what is my investment for that 1 rupee of output? It's much smaller.
Yes.
So services sector, things like hair salons, nail salons, tattoo shops, McDonald's, Kentucky Fried Chicken and, Indian Tandoori Fried Chicken, it doesn't require a lot of capex. Right? So India also needs that and is seeing a lot of that. So that ICOR number used to be 4. So 28 rupees of savings in the economy, 28%. When you invest it, that ICOR, if it all found its way to investment, 28 divided by 4 would give you a 7% rate of growth of GDP. Right. However, all the money doesn't get invested. We buy real estate, we buy gold, it's unproductive. It Correct. Doesn't move in the system. So take out 20% of that 7. So you're left with 5.4% growth rate. Okay. 80%, 5.6%. 80% actually moving the economy, 20% your real estate and gold sitting at home doing nothing. So 5.6% rate of growth was domestic savings. Then the multinationals come in. Foreign money comes in. That's extra capital on the same engine. So you get 6.2%. The same engine is what will drive you in economic theory. So that's the theory. Now the government has to put in place policies, which they started doing since 1991, to encourage consumption, to encourage private investment, to encourage multinationals. All that's put in place. So the engine will keep on going for the next 2 decades easily.
Fantastic. I think on that note, we'll call it on this conversation. I'm already looking forward to the next time we meet in chat. Thanks so much, Ajit, for taking the time.
Thank you so much, Alex. Really appreciate it.